For years, silver was treated like the financial equivalent of a dusty treadmill in the garage. Everyone knew it was there. Nobody thought it would ever do anything exciting. The experts rolled their eyes. The anchors on CNBC smirked. Financial advisors told you to stop wasting money on heavy metal and just buy tech stocks like a normal person. Silver was boring, obsolete, a pet rock. Well, the pet rock just turned into a rocket ship. Today is January 19th, 2026, and if you are holding physical silver, you're not sipping coffee. You're probably staring at your portfolio and wondering if the numbers are broken. The global markets opened and the verdict is in. Silver didn't just break out. It didn't just rally. It went vertical. Spot silver just printed a new all-time high, $94.30 an ounce. Take a moment with that number, $94. We started this year around $71. That was 19 days ago, not 19 months, not 19 quarters, 19 days. In less than 3 weeks, silver is up 31%. 31% in under a month. If you try to annualize that, your calculator files a restraining order. This is no longer a normal bull market. This is a melt-up. This is not price discovery. This is price panic. This is what a currency crisis looks like when it wears a disguise and pretends to be a commodities rally. Silver is now outperforming Bitcoin. It is outperforming the S&P 500. It is outperforming the Magnificent Seven tech stocks. The most boring asset on the planet just became the hottest trade on Wall Street. Somewhere, a financial advisor is quietly deleting old emails. And the best part? The mainstream media still has no idea what to do with this. They are scrambling for explanations. I saw one headline claiming silver is rising due to speculative flows. Speculative flows. Let me translate that from financial jargon into plain English. And when a market rises 31% in 19 days, that is not speculation. That is panic. That is capital sprinting out of a burning building and trying to squeeze through the tiny door labeled real assets. This move validates everything we've been discussing for the past year. It validates the tariff trap. The market understands that U.S. silver is trapped inside the country. It understands that London vaults are effectively cut off. So the U.S. price is being violently repriced to match global reality. It validates the quiet sovereign default at the U.S. Mint. When you can't buy eagles from the government, billions of dollars in retail demand get forced into the spot market instead. That is not a small detail. That is rocket fuel. And most importantly, it validates the physics of the shortage itself. Look at the chart. The move from $90 to $94 happened in a single session, nearly 5% overnight. That is what happens when sellers disappear. Ask yourself, who is selling silver at $90? Are miners selling? No. They are either holding back supply, waiting for triple digits, or they have already sold forward production to industrial buyers in private off-market deals. Are retail stackers selling? Absolutely not. They're terrified of inflation and supply breakdowns. They're still buying, not cashing out. Are banks selling? We already covered this. The banks have capitulated. They are no longer leaning on the price. They are scrambling to cover their shorts. They have switched sides. So now you have a market with inelastic demand and vanishing supply. In economics, when both curves go vertical, the price doesn't gently rise. It explodes. This is the early phase of hypermonetization. Silver is being reclassified in real time, from industrial commodity to monetary asset. At $94, silver is no longer just something inside a solar panel. It is functioning as a currency, a parallel store of wealth, a competitor to gold. And speaking of gold, look at the yellow metal. It is trading near 4,730. Gold is strong, but silver is on a different gear. The gold to silver ratio is collapsing, falling from nearly 60 to 1 down to roughly 49 to 1 in weeks. This ratio compression is the engine of the wealth transfer. It means silver is gaining purchasing power faster than gold. It means the so-called poor man's gold is quietly making the poor man rich. But now we need to slow down, just slightly, and inject some reality into the euphoria. Because vertical markets are exciting, but they are also fragile. When an asset goes parabolic and your net worth jumps 30% in a month, the brain starts doing dangerous math. You multiply $94 by your ounce count. You start pricing vacation homes. You start mentally retiring on a Tuesday afternoon. This is where people get hurt. A vertical market attracts hot money. It attracts leverage addicts who borrow to chase momentum. And the banks are watching this carefully. The higher the paper price goes, the easier it becomes to engineer violent shakeouts. Yes, we hit $94 today. That is real. But do not assume we go to $98 tomorrow and $100 the day after in a straight line. The road to triple digits will be paved with volatility. However, something has changed this time. There's a new buyer entering the market, one with deeper pockets than the banks and more desperation than retail. We've talked about solar, we've talked about electric vehicles, but now analysts are finally waking up to the third engine of silver demand. And this engine is larger, faster, and hungrier than the first two combined. Artificial intelligence. When people think about AI, they think about software, chatbots, code, algorithms. They forget one critical thing. Software does not float in the air. It runs on hardware. AI lives inside massive data centers, warehouses filled with millions of servers, billions of chips, and oceans of wiring. And the physics of that hardware is not negotiable. Artificial intelligence requires speed. It requires ultra-low latency. When machines are trained to think in real time, electrical signals must move as fast as physically possible. There's only one element that conducts electricity better than any other metal on Earth. It is not copper. It is not gold. It is silver. Silver is the most electrically conductive metal in the periodic table. In high-performance computing, silver is not a luxury. It is a necessity. You cannot build cutting-edge NVIDIA chips, high-speed interconnects, and advanced server architecture using slow materials. Physics doesn't care about your budget. Every major AI build-out, Microsoft, Google, Amazon, is quietly becoming a silver vacuum. These data centers are not just consuming power, they are consuming metal. And unlike jewelry demand, this silver is not recycled back into the market. It is locked inside machines for decades. This is what makes this cycle different from 1980 and 2011. Back then, silver was primarily money. Today, silver is money and infrastructure. It is both a monetary hedge and an industrial choke point. It is no longer optional. It is the nervous system of the digital economy. That is why this rally is not just speculative froth. It is a structural repricing of a metal that spent 40 years mispriced. The world changed. Silver didn't, until now. At 94s, we are watching the market wake up all at once. The banks are scrambling. The media is confused. Supply is locked. Demand is accelerating. The war is not over. It is entering a more violent phase. Silver is no longer asking for attention. It is taking it. While everyone is busy arguing about software models and chatbots, the real revolution is happening at the hardware level. And this is where silver quietly becomes the star of the show. Copper simply can't keep up anymore. It runs hotter, it loses efficiency, and at the extreme speeds modern computing requires, it becomes a bottleneck. Silver, on the other hand, runs cooler and faster. It is the silent enabler of the digital age, the coolant of the information economy. Without it, the machines driving AI quite literally overheat and fail. Now zoom out and look at what is happening around the world. A historic wave of AI data center construction is underway across the United States, Europe, and Asia. Microsoft, Google, Amazon, these companies are not tinkering at the edges. They are spending hundreds of billions of dollars to build the backbone of the next technological era. These are some of the largest industrial projects in human history, and every single one of them is a silver black hole. Silver is in the electrical contacts. It is in the soldering. It is in the switches. It is in the semiconductor packaging. It is woven through these facilities at every critical junction. The irony is that most Wall Street analysts still model silver demand as if we live in 2005. Their spreadsheets are focused on jewelry, cutlery, and coins. They have not yet priced in the AI premium. They do not realize that the cloud, this invisible digital world, is physically lined with silver. Before we go deeper, I need to address something important. We are not a synthetic operation. We are real people doing real research. Unfortunately, a wave of imitation channels has appeared, copying our avatar, recycling our scripts, and reposting our work while pretending to be us. We have one channel, and it is this one. We do not sell crypto on Telegram. We do not operate under alternate names on social media. The copycats are trying to harvest fruit from a tree they never planted. We take research seriously because we respect your time and your intelligence. If you value real analysis over cheap imitations, go into the comments and type "staying with the original." Help protect this community and make it clear where serious research lives. Now back to the AI demand shock, because this is where the story becomes truly explosive. The most important detail is not just how much silver AI consumes, but who is doing the buying. When a jeweler buys silver, price matters. When an electronics manufacturer builds a phone, margins matter. But when a tech giant builds AI infrastructure, price barely registers. Microsoft, Apple, Google, these companies sit on cash piles larger than the GDP of many nations. If Microsoft commits $10 billion to a data center, the silver inside that facility is a rounding error in the total budget. If silver doubles, it does not change the project. But here is the key point. The project cannot function without silver. That makes their demand perfectly inelastic. They are not buying silver because it is cheap. They are buying it because it is essential. If silver were $500 an ounce tomorrow, Google would still buy it because the alternative is losing the AI arms race. For them, silver is not a commodity. It is strategic infrastructure. This is what happens when the silver squeeze collides with the AI arms race. The tech giants understand supply chain fragility better than anyone. They lived through the semiconductor shortage of 2020. They learned that Just in time, delivery is a fantasy when global systems fracture. So they are changing strategy. Instead of waiting for metal to appear on the open market, they are going upstream. We are hearing increasing reports that major technology firms are signing direct off-take agreements with refiners. They are securing supply before it ever touches the exchanges. This explains a critical mystery: why futures vault inventories are draining even as prices rise. The silver is not flowing to investors. It is being absorbed into the strategic reserves of Silicon Valley. This layer of demand did not exist in 1980. It did not exist in 2011. Back then, silver was primarily money. Today, silver is money and technology. And this matters because industrial silver does not come back quickly. You can melt jewelry, you can sell coins, but you cannot recycle a newly built data center. That metal is locked into servers and wiring for 10 or 20 years. It is removed from circulation. Now look at the supply math. Solar already consumes over 20% of annual production. Electric vehicles take another 10 to 15%. And now AI is entering the equation, potentially absorbing another 10%. That means roughly 45% of global silver supply is being consumed by just 3 industries. That leaves limited material for jewelry and virtually nothing for investment bars and coins. At the same time, that investment demand is hitting record highs. We've seen ETFs record months of relentless inflows, too many buyers, too few chairs. This is why the AI demand shock acts as a turbocharger. Even if monetary demand pauses temporarily, industrial demand keeps tightening the market. That is why the breakout above $94 is not built on hype. It is built on physical necessity. Paper traders can create contracts. Central banks can create currency. But no one can print silver for Microsoft. Eventually, the industrial user shows up and demands delivery. And when that happens, price discovery shifts from speculation to desperation. We are entering the phase of industrial desperation. That vertical move to $94 was not random. It was the market realizing there's not enough metal to build the future that governments and corporations have promised. Celebrate the moment. You were right. You were early. But do not confuse correctness with safety. Perfect fundamentals do not produce smooth charts. The banks have lost control of the trend, but they are not powerless. Wounded animals are dangerous. They still have algorithms. They still have leverage. And they still specialize in one thing: creating volatility. History tells us that every time silver breaks major levels, retaliation follows. If you assume a straight line to $150 and load up on margin at $94, you are stepping into a kill zone. Leverage turns a strong position into a fragile one. And fragility is what the banks hunt. Right now, emotions are running hot. Green candles make people feel invincible. Screens glow, accounts surge, and the brain starts whispering that this time is different, that corrections no longer exist. That feeling is exactly what large players wait for. They want greed to replace discipline. They want traders fully exposed when the trap is sprung. The destination for silver is higher. The AI demand virtually guarantees it. But the path will not be gentle. The banks may have lost the war for control of the metal, but they still control the battlefield in the short term. The technology is changing the world. Silver is powering the technology. And you are positioned at the center of that transformation. Just remember to keep your seatbelt fastened, because the turbulence is only beginning. Right now, with silver screaming higher and headlines getting louder by the hour, this is the exact moment when most people forget the most expensive lesson in markets. History doesn't repeat perfectly, but it rhymes with painful accuracy. And if you ignore that rhyme scheme, it will happily rewrite your life savings for you. So let's talk about the history of violence in the silver market, because this rally did not begin yesterday, and the tactics being used against traders are not new. They are refined, they are deliberate, and they are ruthless. Go back less than a month to December 29th, 2025. We had just smashed through $80. The mood was electric. Social media was calling for $100 overnight. Everyone felt brilliant. And then the trap snapped shut. In a single session, the banks drove silver from $83 down to $70. A 16% collapse in hours. No warning, no mercy. Billions of dollars in retail capital were erased. The people who chased the breakout on margin didn't just lose money. They were liquidated. Their positions were closed for them. Game over. 10 days later, January 8th, the market looked healed. Silver had clawed its way back to $82. Confidence returned. The bulls were back in charge. Deja vu arrived right on schedule. Another engineered smash, another rug pull. 12% down, straight to $74. Headlines screamed double top. Weak hands sold the bottom, and the banks quietly reloaded. Then look at last week, January 15th. We tagged $93. Euphoria everywhere. By lunchtime, we were trading at $86, 7% wiped out in hours. Do you see the pattern? December 29th, minus 16%. January 8th, minus 12%. January 15th, minus 7%. That is not random volatility. That is a hunting pattern. The banks are not guessing. They can see the order book. They know exactly where stop losses are stacked. They know how much leverage is in the system. All they have to do is push the price far enough to trigger the first wave of forced selling. Your own stops become their weapon. One shove turns into an avalanche. This is how predators hunt in modern markets. Not with brute force, but with precision. And now here we are at $94, the highest price in history. That means the risk of a violent washout is higher today than it was yesterday. The more crowded the long side becomes, the easier it is to tip the boat. This isn't meant to scare you. It's meant to keep you alive financially. Let's make this practical. Suppose someone buys a silver futures contract today at $94. If the banks engineer a routine 10% correction, silver falls to $84.60. That's nothing historically. It's a normal swing. But if that trader is using 10 to 1 leverage, a 10% move wipes out 100% of their equity. They are done. And here's the cruelty of it. The very next day, the price may rebound to $100 on AI demand and supply panic. The fundamentals will still be intact, but the trader is gone. They were right on direction and destroyed on timing. This is the vertical trap. The banks cannot stop silver long term, but they can still dominate the paper battlefield. They cannot win the war, so they farm casualties along the way. That is why we constantly emphasize physical silver. Think about the investor who bought physical at $83 on December 29th. When the price collapsed to $70, did he get a margin call? No. Did his silver vanish? No. He simply waited. Today, he is up 13%. Physical silver has no leverage. It has no stop losses. It cannot be hunted by algorithms. A flash crash on the exchange is just a headline when you own the metal outright. That is immunity. We are now entering a period of extreme danger. The $94 level is a bullseye painted on the market. Volatility is likely to expand, not contract. $10 daily swings are no longer unthinkable. Ask yourself honestly, if you woke up tomorrow and silver was down $8, would you panic? If the answer is yes, you are carrying too much risk. The banks are wounded animals facing enormous losses. And wounded animals fight dirty. They want your silver to cover their shorts. The easiest way to get it is to shake you out of weak hands. The trend is up. The destination is triple digits. But the road from $94 to $100 is a minefield. Which brings us to the real conclusion. You now see the full picture. The trend is vertical. The fundamentals are extraordinary. But the game itself is rigged. So how do you win a rigged game? You stop playing by their rules. You take your chips off their table. You walk out with the prize. This is the physical silver manifesto. For decades, the system convinced the world that a paper claim on silver is the same thing as silver. It isn't. Paper silver is a promise. Physical silver is possession. In stable times, promises work. In crises, promises break. And after a 31% move in 19 days, we are not in stable times. Rule number 1, do not sell for dollars. I know the temptation is loud right now. Some of you are up 300%. The profit looks life-changing. But pause and ask a deeper question. What exactly are you buying with those dollars? Are you parking them in a banking system that is technically insolvent? Are you trading a scarce asset for a currency that can be created in unlimited quantities? Selling silver for dollars right now is like trading a lifeboat for a ticket back onto the Titanic. Silver is not getting expensive. The dollar is getting weaker. Rule number 2, the ounces to acres strategy. You do not sell silver to hold cash. You sell silver to acquire a productive, cash-flowing hard asset that can feed your family. Historically, in 1980, it took about 800 ounces of silver to buy the average home. Today, even at $94, it takes roughly 4,500 ounces. We are not there yet. You wait for ratio compression. You wait for the moment when you can trade metal for land, business, or infrastructure. You walk into a closing with a monster box and walk out with a deed. That is generational wealth conversion. Rule number 3, prepare for cash settlement risk. If you hold futures or ETFs and silver hits $150, read the prospectus. Many instruments reserve the right to settle in cash. They can close your position and mail you a check. Then you take that check to a coin shop and discover physical silver is trading at $300 on the street. You were paid in a currency that can no longer buy the asset you wanted. Physical silver cannot be cash settled. It has no counterparty risk. It cannot default. That is why physical ownership is not ideology. It is risk management. We are at $94. The psychological magnet of $100 is pulling hard. Everything points higher. But expect turbulence. The banks may try to drive silver back to $88 or lower to flush out weak hands. If that happens, do not panic. Look at your stack. It weighs the same. It shines the same. A paper smash is not a failure. It is a final gift. One more chance to exchange dying dollars for living metal before silver becomes unobtainable. The train is leaving the station at 94 miles per hour. Hold the line. The era of cheap silver is over. The era of the melt-up has begun. Do not let them trick you out of your victory. Welcome to the age of silver.